Welcome to the platform for investor education. We're going to talk about futures and forward contracts today. Suppose you go to the market to buy coffee, say on January 1st of any year. You go to a store, pay your money, and receive your favorite Peaberry. Think of this as transacting in a spot market where money and underlying commodity change hands at the same time. You have paid January prices for January coffee. Suppose instead that you wish to buy coffee for your Coffee Day franchise 3 months from now, say April. You could buy the coffee in the spot market in April. But what if the price of the coffee changes from January to April, which it probably will? There is a supply-demand story at work, isn't there? Too high and the profits from your business dry up. This is called input price risk, right? On the flip side, think of the coffee planter in Chikmagalur. Coffee prices come down before he collects his crop and sells his beans. Say also in April, he or she may not recover their investment in land, fertilizer, manpower to grow the coffee. There is that price risk again, this time on the other side. This is why you have forward contracts. The coffee grower agrees on a price today, January the 1st, but delivers the coffee in April and receives that agreed upon price in April. If the April spot price ends up higher, he still only gets the price agreed upon. Likewise, the Coffee Day franchisee pays a lower price than the higher April spot price and is happy. Both of them have locked into an amount to be received and paid in April. One could have received more, the other ended up paying less. But for both, the price is locked in. The uncertainty regarding April prices have been removed. Formally, this forward contract is a binding agreement between two parties to exchange some underlying asset at a specified price at a specified date in the future. Such contracts are part of a class of contingent contracts called derivative contracts. What this broadly means is that the value of this contract is derived from, contingent upon, the price behavior of some underlying asset, coffee in our case above. Take another example, this time of a wheat farmer who plants his crop today in anticipation of his harvest in 3 months. He lays out his investment in seeds, fertilizer, and labor. It is not hard to see that the farmer faces price risk in that if crop prices were to fall 3 months from now, he may not even recover his initial investment. Diametrically opposed is the situation of a breakfast cereal manufacturer who is buying every 3 months. He is concerned about possible increases in wheat prices over the next 3 months. This will increase his cost of cereal production and reduce, if not eliminate, his profits from that activity. Getting the point? See the economic sense for the two parties to enter into a contract today? By locking into a price for future delivery, they have eliminated price uncertainty and can go about managing their respective business operations. Both parties are essentially using this contract to hedge their risks. For one, it is that of prices falling. For the other, it is that of prices rising. Forward contracts have been around forever, dating back to medieval times. More recently, markets now enable agents to trade such contracts systematically on exchanges, notably the Chicago Mercantile Exchange, the Intercontinental Exchange, and the National Stock Exchange in India, amongst others. When forward contracts are executed through such exchanges, they are referred to as futures contracts. Futures contracts are available on a wide range of assets: agricultural commodities, metals, both industrial and precious, crude oil, major currencies, and interest rate dependent securities such as government bonds, even individual stocks and stock indices. Indeed, the volume of trading in individual stock futures in India is amongst the highest in the world. Some terminology. The party agreeing to buy is called the long side of the contract, and the party agreeing to sell is called the short side of the contract. For exchange-traded contracts, each party interacts with the exchange. The exchange collects the margin, which is about 5 to 10% of the value of the underlying deliverable from each party to ensure compliance with the terms of the contract. We talked about coffee growers and wheat farmers, coffee day franchises, and cereal manufacturers. Both of them have a direct involvement with the underlying asset. Both of them have an incentive to enter the futures market to protect their investment, i.e., to hedge their price risk. They are not looking to make profits from the contract per se. They are natural hedgers. They are also individuals who may choose to purely speculate on the price movements of coffee or wheat or any other commodity for that matter. Those who are bullish on coffee prices will take long positions in the coffee futures, and those bearish will take short positions. Not having any interest in the coffee, they will close out their positions before the futures contract expires and book their gains or losses, just like speculators in any other markets that we have seen on the PI site. These speculators provide liquidity to the underlying marketplace, taking the other side of the position that the natural hedger wants. Suppose you think that coffee prices will increase between January and April. You take the long side of an April coffee futures contract to buy 100 kilograms of coffee at a price of rupees 400 per kilogram. That is, you agree in January to pay rupees 40,000 in April for those 100 kilos. The price is decided in January but paid in April when the coffee is delivered. Think of this rupees 400 as the January price for April coffee. If the coffee prices in April turn out to be rupees 420 per kilo, you have made a profit of 2,000 rupees, 20 rupees per kilo, as you get to buy coffee which is worth 42,000 by paying the contracted price of only 40,000. Conversely, the short side of the contract will lose 2,000 as he will have to deliver coffee worth 42,000 for the contracted price of 40,000. If, however, coffee prices were to fall, the long side loses and the short side gains. It should be obvious by now that there are two markets operating in parallel. The spot market, where economic agents can buy or sell the asset immediately, and a futures market, where the asset can be bought or sold at a future date. So how does the spot price compare with the price being quoted for future delivery? The spot market price changes as daily supply and demand changes. The April futures price similarly changes as expectations of April coffee prices change. You would expect the two to be linked, would you not? And indeed they are, a relationship known as spot futures parity, which appears in our deep dive. In our coffee example, the spot price for coffee will change from January to April. The futures price for April coffee will change from January to April too. But in April, the two prices will converge. In January, the futures prices for April coffee may be different from the January coffee spot price. But in April, the futures price for April coffee should be the same as the spot price in April, shouldn't it? In addition to natural hedgers and speculators, there are sophisticated players too, those that believe the spot and futures price are out of sync and will initiate arbitrage trading strategies. But those are stories for another day and available in the deep dives on the PI site. As always, come back for more.